Hello everyone, this is the fourth and final video in our flexible budgets and standard costing series, and in this video we're going to be adding some additional information about variances and something you'll find is kind of important. So I hope you watch this video through to the end. So on this particular slide here, there's actually two topics. So I want to make sure that's very, very clear. This bottom topic I'll talk about here in just a second, but that is totally different from the topic on top. So don't get these two mixed together. They're two totally different topics here. The first one is specific to materials. It has nothing to do with labor, nothing to do with overhead. So we can make that distinction as well. So in our video about material variances, we always talked about when materials purchased equals materials used, but that's not always the case. Sometimes materials that we purchase are different from the amount that's used, and when that happens, we can't use that simple little diagram that we introduced in video 1 when we were talking about material variances. We have to use what I call the weird diagram, and here's what that looks like. So it looks a little bit different from the diagrams that we've seen before. Now, some people draw the diagram like this. The idea is that you always have two pegs somewhere in the center. That's the idea. So you may see it either one of these two ways, but this is the way I like to draw mine. So now I'm going to label these pegs just like we have always done. So the first peg is actual quantity times actual price. The second peg is actual quantity times standard price. And now we have two middle pegs, so actual quantity times standard price. And the third peg, standard quantity times standard price. So again, everything's the same so far, nothing different. Now remember, the variances that we calculate for materials is the price variance and the quantity variance. Remember, we talked about this when we journalized. The price variance is based on materials purchased. We can remember that because price starts with a P, purchase starts with a P, and the quantity variance is based on materials used. All right, so when we're looking at these pegs, for example, actual quantity here in this peg, we're looking for actual quantity of materials purchased. In this actual quantity peg, this piece here, we're looking for quantity of materials used. So you could actually use this diagram when they're the same as well. That way you're always safe. It's just those two middle pegs would be the same number. But you have to use this diagram if materials purchased do not equal materials used. That way you have two different middle pegs. There'll be two different numbers there for those two middle pegs. All right, so now when you journalize these, just to kind of give you an idea, if this were to happen, this would be your journal entry for materials purchased. So this would be your price variance there. And you would journalize these three numbers for your materials used, and there would be a quantity variance there. Okay, so just a little bit different. So now when you're reading your problems and you're asked to calculate material variances, now you have to look for one additional thing. You have to determine whether materials purchased equals materials used. If they do, then you can use the simple little diagram. If they do not equal, then you have to use this diagram or something similar to it that will give you two pegs in the middle. Now let's look at this bottom topic here. Denominator level, normal volume. You also may see expected volume as well. This only deals with fixed overhead variances, nothing else. So if you notice, this is a fixed overhead diagram here. And these words, denominator level, normal volume, expected volume, anytime you see that, it will be used in this peg. Specifically, you would use it divided by the budgeted cost, probably to get this standard price over here that we did in our example when we're looking at overhead variances. So when you see these words, kind of give yourself a pause there, and remember they only go one place, and that's that budgeted peg in your fixed overhead diagram. Okay? So before we close out this video, let's look at an example. Let's go back to Salisbury Inc., which we did for our materials and labor variances. And in this case, materials purchased do not equal materials used. So this is the same problem we did, so I'm not going to read through it again. But what I want to point out is square yards of input purchased was 6,000 and used 3,700. So they're a little bit different here. So the first thing we would do is draw our diagram and label everything. Now, since quantity purchased does not equal quantity used, I'm using the weird diagram in this case. So remember, the price variance is based on materials purchased. So the actual quantity in these first two pegs here will be based on materials purchased. So the actual quantity of materials purchased was 6,000, and the actual price was $5.10. So my actual cost in this case would be $30,600. My middle peg, actual quantity purchased, is still 6,000. The price I should have paid is $5. So that gives me $30,000 here. So my price variance would be 600 unfavorable because we paid 10 cents more than we should have. And our quantity variance, so the quantity used was 3,700 and our price, standard price, was $5. So our standard price again is $5. Standard quantity, what should have happened at the actual level of production. Actual level of production was 2,000 chairs. What should have happened was 2 square yards per chair. That gives me a standard cost of 20,000. So that number really didn't change from the first time we did this problem. And our quantity variance then would be 1,500 favorable. Now, one thing I want to point out that's different when materials purchased does not equal materials used. We cannot have a flexible budget variance. We cannot have this because materials purchased does not equal materials used. So you cannot combine these two variances into an overall variance called flexible budget variance. So you cannot have this if materials purchased do not equal materials used. Don't forget to give my video a thumbs up if you found it helpful. Also, subscribe to my YouTube channel, and therefore you would get announcements of when new videos have been uploaded. Also, please visit my website at theaccountingdoctor.com, where you'll find other interesting accounting information, games, lecture notes, and even more videos.